Okay, let's actually get into some of the nitty gritty now. And what that means for us is that we're actually going to start looking at specifics. Rule number 2. Simple criteria that work well. We can keep it simple and it can work well. And the reason I know this is because having won competition after competition in the public eye, let alone my own trading, there's no point in my talking about my own trading because that's not in the public eye. What is in the public eye is when through live portfolios we go through them. For instance, I was asked in January 2004 to pick a medium-term 12-month portfolio for Barclays stockbrokers clients on a teleconference, which we did. And I picked a medium risk portfolio and I selected certain criteria around it. And we looked at the progress as the year went on. So it was a live portfolio. There was no sort of going back and saying, oh, by the way, I happen to have done this year. No, we actually did it at the start of the year instead, and with a reputable broker. And that's the difference with my trading technique. I am willing to put it on the line and my head on the chopping block. So, before I go through the actual criteria and some of the simple criteria that we can use, let me tell you what the result was. The result was, these were the companies which in January of 2004 came out of my criteria. They achieved a 33% return, which you might think, well, it's okay, 33%, could have done with 100. Remember, that wasn't leveraged. So for those of us who are spread bettors and CFD traders or options traders, this was without leverage. With leverage, we may well have reached 100%. And the other reason why it wasn't leveraged was because I was looking at medium risk for the slightly longer term investor. Now, we can have different ones for different investments. We'll see some momentum trading, some short-term trading as we progress through this CD. But those are the names of the stocks. Fine, fair enough. As I said, willing to put my head on the block. But what are the criteria? And can we really keep them simple? Well, I did, and I keep them simple for my long-term portfolio in any event. I trade short-term. I like to hold positions for a week to a month to 3 months. But I also keep a longer-term portfolio. Now, as I said to Barclays, and part of the rules of publicity in the game are that if you're going to mention certain stocks, you don't want to be owning them at the same time if you're going to do it in the media. It was the same rule I had with the Financial Times, which is when I would mention any stocks in the newspaper, I had to disclose that I didn't actually own them. They prefer doing it that way. My view is somebody should be made to put their money where their mouth is and actually own the damn stocks that they recommend. But anyway, these were the ones that I recommend for Barclays. As I say, didn't own. I was willing to forgo the benefit of that. That's partly because most of my trading is US based, partly because of, as I say, the rules of the game. What were the criteria which I know work time and again? Well, let me run through them in brief. Where I'm going to run through them in detail, I'll come to in a second, but for now, let me run through them in brief. First of all, I'm looking for a price rise over a 20-day period. The percentage that I'm looking for here is roughly, it should be up about 5% at least over the past 20 days. Sometimes I'll settle for 4%, sometimes for 3%. Over a 6-month period, I'm looking for it to be up at least 10%. The reason for that is I'm looking for the price direction. I'm looking for a trend which is already showing money to be getting in. I'm not one of those people who's looking to outsmart the market and get in before everybody else does. I want to start getting in just as the money starts getting in itself. So 6 months, roughly an 8 to 10% rise. Technical indicators like the MACD, moving average convergence divergence, and stochastic, I'll look at just for short-term timing if it's for a longer-term portfolio such as this. Now, I'm not going to go into the details about charting yet. That's in a later rule. For now, I'll just flag that that's one of the simple criteria that I will look at. Yield, that's dividend yield. For every £100 of stock, how much in dividends do I get? Does the stock, for every £100 I own of it, pay me, say, 6%, far better than a bank account? The yield that I'm looking for on a stock, a range between 4 to 10% current environment. The reason for that is because a lot of fund managers like that. And if fund managers like it, then I like it. Not because I think fund managers are particularly skilled. They're not. They're appalling at what they do. They're absolutely useless at their task, which is giving a return to people. The reason I like it is because if they're putting their money behind a stock, it'll give it some degree of support. Latest profit, I want them to be up year on year, and I'll show you later on the kinds of software and websites, usually free or very cheap, which can show you how to find this information, like the latest year-on-year profit rises. I want year-on-year revenue growth. Of course I do, because I'm looking at value and at growth. News. Now this is an unusual one. I look at this again through a free website like investingbetter.com, because I want to make sure there's a lot of positive news coming out about the company. Why do I want to make sure there's a lot of positive news? Very simple reason. That if we're getting that kind of news flow, then somebody else is going to pick up on it. A journalist is going to write about it, or there is genuinely reason to be putting money in. And that's a criteria down there. Then I want to look at the price-earnings ratio, again a measure of value, and the price-earnings growth ratio. Now, these are weighted differently. For instance, if something had a PEG, price earnings growth ratio, below 1, that tells me it's undervalued. I need it to be under 1, i.e. to some extent, the earnings growth of the stock is such that the stock is undervalued. Now you might be thinking, I've not heard of PEGs or PEs, or you might be thinking you have, and that's fine. We explain this in greater detail, not just in this, but in the other CDs courses, the more detailed courses. Now, the reason that I mentioned these two criteria are because I'm looking not just for growth, which is what you get from profit and revenue, but also for value, which is what I get here. So PEs, I'm looking for between 15 to 24. PEGs, I'm looking for under 1. And then it throws up companies like this and gives me on a medium risk basis 33% return. Not bad. By the way, every single one of these stocks rose. Overall, this portfolio in 2004 beat the FTSE All-Share and the FTSE 100 and the FTSE 250 indices. In other words, it wasn't just because a rising tide raises all boats. It wasn't just because the general market was rising. Now, I've only given a brief overview of these criteria, which is what you can do in a short CD. But one of the ways we can save our time when we're looking for these, which is an issue which comes up on these, is using simple pieces of software such as this one, which is set up, click of a button, bang, shows me all of these, and I get the stock names. That's why I said it can be simple. As long as you know what you're looking for and you've got somebody to show you and explain to you why you're looking for it. And this is just one set of criteria. I have momentum criteria, I have worse stocks, overvalued stocks criteria for those who want to spread bet and short stocks. Those criteria fit in well there. But it's not just pieces of software which give us all of that. Of course, one of the other ways I won the Bloomberg competition was to look at websites like this. For those of you who don't know, the Bloomberg competition I won was they looked at all of my long picks, in other words, the one that I recommended would go up, all the stocks which would go down, and this was done each week. I had to give a new pick on the long side and on the short side every single week for 6 months. That's 52 picks. I beat every other analyst, guru, pundit, fund manager, you name it, on the channel that they analyzed, and it was them who went through the figures. And the reason I beat them was because I was using sensible software like this to make my life a lot easier. What used to annoy them when I used to come in on Wednesdays to do the show is that I'd bring my own computer and not use the Bloomberg terminal. Why wasn't I using this incredibly expensive piece of machinery? Well, because there are simple criteria that work well. I know I've only outlined them. The issue then becomes, okay, simple criteria that work well, give me the detail. I will in a second. But first, I want to go through some of the questions you need to ask when you're looking for simple criteria. Which are the right, proven, and wrong? Incidentally, wrong tends to be popular way to pick stocks. The stock theories of the best fund managers and how can you apply them? Which are the best free websites? And I just mentioned one, for instance, that you can quickly find great stocks. How do you effectively swing trade, hold positions for a week or two, and keep that day job? Which are the indicators that major banks use for long-term investments and short-term trades, and how do we learn those? And what are the trading signals used by professionals, and how do they use them? And why are they not that difficult to learn in actual fact? These are the things you need to know about using price charts. What are they? What is the MACD? What is stochastics? What are Bollinger Bands when trading CFDs and spread betting, for instance? Why should you not use indicators the way the textbooks teach you, for instance? These are the questions you need answered. I'm going to get to the answers in a second. Okay, so if those are the questions that you need answered, and I've said I've only taught you the criterion outline, well, I've given you some solid material, which is solid criteria, but where do we go into detail? Well, it's a result of this and all the emails I get and the inquiries for more and more knowledge that we created a whole set of CDs around it, and you can see the detail there. By the way, don't forget, whilst you're listening to all of this on the computer, you can press the spacebar at any moment if you want to pause, or press Alt-Enter to put it full screen. You should have Alt-Enter on anyway, just so it is full screen. But for those of you who are interested, we created, for the more investor guide side of things, these online investing CDs and investing with a day job and getting the kids into investing. More details on how to get these later on in the CD and actually on the CD menu. But I mention it, and on investingbetter.com, but I mention it because I can only touch upon the rules. We've got a heck of a lot more rules to get through, so I'll leave this on screen for you to look at for now. But that's rule number 2.